Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're going to explore the recent $2.7 billion sale of Pizza Hut and why this move is actually a smart and strategic decision. This transaction involves well-known brands like Pizza Hut and Yum brands, alongside the investment firm Long Range Capital. Over the next few minutes, I'll walk you through the key reasons behind this deal, how it benefits the companies involved, and what it means for the future of Pizza Hut in a competitive market. Let's dive into the details and understand why this sale is more than just a financial transaction. It's a clever business strategy. When Yum Brands announced the sale of Pizza Hut in the US for about $2.7 billion, many saw it as a sign of retreat, like giving up on a brand that hadn't been performing well. But that's not the right way to look at it. This isn't about failure, it's about smart decision-making. What Yum Brands did here is a classic example of effective capital allocation. They decided to sell an asset that wasn't delivering the kind of growth they needed and instead focused their resources on stronger brands like KFC and Taco Bell. This choice made the overall company leaner, more focused, and set it up for higher growth and value. So instead of seeing this as a loss for Pizza Hut, it should be seen as a strategic step forward that highlights strong management and a clear strategy for future success. At its core, Yum Brand's decision to sell Pizza Hut was focused on maximizing shareholder value. After a strategic review that began in late 2025, management determined that Pizza Hut was no longer the best use of their capital, time, or leadership resources. The sale had four clear objectives, starting with improving the overall quality of the portfolio. Pizza Hut had become the weakest asset, facing declining sales and profits, losing market share to competitors like Domino's, and dealing with structural issues around delivery, pricing, and digital capabilities. At the same time, Yum saw stronger, consistent growth from KFC and Taco Bell, both of which offered better economics and more promising prospects. The second objective was to refocus the company's efforts on its core growth engines, KFC, known for its global expansion potential, and Taco Bell, which drives high margins through innovation. These brands provide clearer, scalable opportunities for international growth, making them the key priorities moving forward. The sale brings in about $2.3 billion in net proceeds, which offers Yum Brands a valuable opportunity to reinvest this capital where it can generate higher returns. This might mean expanding into growth markets that show strong potential, investing in technology like digital platforms such as Byte by Yum, or even returning value directly to shareholders through buybacks. At the same time, stepping away from Pizza Hut simplifies Yum's overall business and reduces risks. Pizza Hut needed a significant turnaround investment with no guaranteed payoff, so by exiting, Yum decreases operational complexity and removes a business that was holding back performance. This allows management to focus their efforts more effectively on the brands with the best chances of success. What Yum Brands did here is a textbook example of portfolio optimization. First, they pinpointed an asset that wasn't a perfect fit anymore. Pizza Hut wasn't failing outright, but its legacy dine-in model was at odds with the modern, digital-first approach many competitors have. It was growing more slowly compared to other brands and needed a capital-intensive turnaround, making it a misfit in terms of where Yum wanted to focus resources. Even with a strong global presence and familiar brand name, that didn't guarantee solid economic returns. So, rather than pouring more money into trying to fix it internally, Yum chose to sell Pizza Hut in two strategic parts, selling the operations outside China to private equity, while transferring the China operations to Yum China, a group better positioned to manage those markets. This approach allowed Yum to exit cleanly and reallocate capital to areas with higher growth potential and better returns. Yum approved a $4 billion share buyback, which is a strong statement to the market about confidence in the company's value. At the same time, they set clear priorities to reinvest capital into initiatives that offer higher returns on investment, ensuring the business continues to grow efficiently. After the sale of Pizza Hut, Yum focuses its narrative much more sharply. Taco Bell aims to dominate the US market and expand internationally, while KFC is positioned for aggressive global unit growth. This focused approach simplifies operations and helps investors understand where the company is headed, which is crucial for how the market values Yum going forward. It's about making the company's story clear and compelling, both inside and outside the business. Divestitures don't always create value, but this one does for a few clear reasons. First, it sharpens Yum's strategic focus by allowing the company to concentrate on what it does best. Research supports that spin-offs and divestitures help improve focus, boost efficiency, and unlock hidden value, both in the parent company and the entity that separates. This is exactly the approach Yum is following. Second, Pizza Hut now belongs to owners who can dedicate the right resources and mindset to turn it around. These operators are able to invest aggressively, take a long-term view focused on a turnaround, and concentrate solely on the pizza category. Meanwhile, Yum can avoid distractions and channel its energy into its remaining core businesses. This ownership match ultimately puts both sides in a better position to succeed. Strong capital discipline plays a key role here. Successful companies don't get attached to assets that aren't delivering the returns they need. In this case, Pizza Hut required significant investment with uncertain results, while KFC and Taco Bell provide clearer and higher return growth opportunities. This decision reflects financial discipline, not just strategy. After the announcement, the stock price increased, which shows investors believe this move creates value rather than reducing scale. Simpler business models like those focused on KFC and Taco Bell are easier for the market to value, and higher growth portfolios tend to attract higher valuation multiples. Finally, the quick service industry is undergoing a major shift with the rise of digital ordering, delivery platforms, and a focus on value-driven consumers. Pizza Hut was slower to adapt to these changes, but Taco Bell and KFC have embraced innovation, expanded internationally, and leveraged digital tools effectively, positioning them well for future growth. The transaction brought in about $2.7 billion in total sale value, with net proceeds of around $2.3 billion after fees and taxes. Yum Brands authorized a $4 billion share repurchase, showing confidence in its future, while also planning to reinvest in growth brands and digital infrastructure. Before the sale, Pizza Hut made up about 12% of revenue, but was underperforming. After the sale, the company's portfolio shifts toward faster-growing, higher-margin brands. This reduces exposure to a declining segment and allows a stronger focus on expanding KFC internationally, adding thousands of new units each year, as well as driving Taco Bell's growth and innovation. The market reacted positively to this move, with shares rising modestly, signaling confidence in the company's strategic direction and capital discipline. This kind of divestiture is not new. It follows a proven strategy that many successful companies have used to unlock value. For example, McDonald's spun off Chipotle, which allowed Chipotle to grow independently and significantly increased its value. Fiat Chrysler separated Ferrari, leading to a higher valuation multiple for Ferrari. General Electric divested its financial services arm, refocusing on its industrial core, which helps simplify operations and boost shareholder value. In each case, the benefits came from removing complexity, sharpening focus on core strengths, and enabling these assets to thrive on their own. Yum's sale of Pizza Hut follows the same logic, positioning the company to concentrate on its stronger brands and create more value for shareholders overall. The story often says Yum brands lost Pizza Hut, but the truth is quite the opposite. They made a strategic choice to optimize their business by exiting a challenging, capital-heavy part of their portfolio. This move freed up billions in capital, allowing them to concentrate on their strongest brands like KFC and Taco Bell. By doing this, they set themselves up for faster growth that is more profitable. This approach is the essence of smart corporate strategy. Great companies don't cling to past assets out of sentiment. They focus on where future returns will be highest and allocate their resources accordingly. This discipline and focus on the future is what winning looks like. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.